Howdy, Jacob here. Today we're looking at Target Hospitality Corporation. They are a hotel, restaurant, leisure industry. They operate as a specialty rental and hospitality service company in North America. Founded in 1978, looks like they've been around for quite a bit. Growth recently has been fairly impressive outside of COVID. They've been growing well into their double digits with the most recent 2 years having return on invested capital very high, averaging mid 20%. Gross margin has grown like crazy. Operating margin in the most recent year at 42% is higher than the gross margin was in 2017 at 40%. So very impressive most recent year, most recent 2 years. Again, I'm a conservative investor in the fact that I question immediately whether I believe that they will be able to keep these or not. So I'll be using averages to be able to forecast the earnings and free cash flow that I think will be most realistic to occur. The balance sheet shows 104 million cash on hand with 178 million long-term debt. So that net debt is 74 million, and they made over that last year. So really no concern from the balance sheet perspective. The company is reinvesting back in themselves a little bit. We see capital expenditures grow. They haven't made an acquisition, or they've netted out, I guess, possibly, but no big acquisition since 2019. And they haven't bought back shares, it looks like, since 2020. The use of cash the last couple of years was just paying down debt, which I guess they incurred due to making some larger acquisitions beyond their capabilities from free cash flow. So that's not concerning. They're deleveraging themselves, but it gets to a point where the company, you know, they're in a fine debt situation. Their balance sheet is very healthy. I think that this company should be able to really focus on reinvesting back in themselves and trying to get high rates of return. And if they're not able to do that, buying back shares at stupendously cheap prices, I think, is the best use of their cash here. Let's start making some assumptions on the revenue growth side. They're still a very small They still have very small revenue and such. They own a network of specialty rental, provide catering and food, maintenance, housekeeping, groundskeeping. Okay. I think 5% seems pretty reasonable. You might think that's very small, but I mean they've been around since 1978. So there's just not a lot of history here compared to their entire history to where I feel like their growth in the next 7 years probably is not going to be this 20% plus rate of return. For margins, I'll probably go closer to what it is now due to the fact that it's been a lot higher recently, but I'll still probably be a bit conservative, saying let's try 12 and 16 maybe. I think shares being relatively flat makes sense to me. There wasn't a whole lot of stock-based compensation, so share issuance through stock-based compensation. And then PE, I don't see a moat here. I'm just going to do the market average, roughly of 15 with a 15% look at return. And we get to a price that needs to fall 47%. I don't think it's a screaming deal now, but it doesn't mean that it's not very far off from one that I think could make a lot of sense for this type of company. Shorter analysis or not super crazy long, but I hope you enjoyed the video and I hope you have a fantastic rest of your day. Thank you.